You're tuned back into Agriculture Today, and we continue our conversation with K-State grain economist Dan O'Brien and senior economist at the International Grain Program, Guy Allen. Guy, continuing our conversation now with that recent WASDE report coming out and talking about soybeans.
Really, the USDA made no changes in the U.S. domestic supply demand balance sheet. Now that those changes may be coming in the January 12th set of reports, but the overall picture is that we're sitting at 245 million bushels of ending stocks projected, and that follows from the higher levels of previous 2 years. Stocks to use this year at 5.85, 5.86% stocks to use. The last couple of years, we were at 6.1, 6.2%. So if anything, we're really in a domestic trend where we're sideways to lower in terms of relative stocks. And we've seen the growth in domestic crush, from 2 years ago, 2.2 billion bushels, 2.204 to 2.212, and then this year up to 2.3. And it as we mentioned earlier, we're seeing the growth of domestic fuel usage, biodiesel, renewable diesel, whichever. And you see that in the crush numbers. The biofuel numbers have been growing the last couple of years as well. So most of the action or excitement in the soybean market is actually on your national side. Guy, you want to address that?
Yeah, looking at the total oilseed complex, we saw global production down slightly to about 661 million metric tons. In contrast, we actually saw USDA increase world soybean production. It was slightly lower from last month, but it came in at 398 or 399, just shy of 400. But that's up about 24 million metric tons from last year, which is a fairly significant increase in soybeans. So total oil seed production was a bit tighter on that. That said, on the trade situation, trade and soybeans is going to be fairly steady, about 170 million metric tons. Ending stocks up just slightly, about 10 million tons to 114. So we're comfortable on soybeans, but it's probably the tightest of the commodities out there. Again, we're seeing that shift continue to happen in the U.S. as the biodiesel and the biofuel situation continues to drive that strong demand for oil, and that's in the longer term going to impact our import mix of whole soybeans versus oil and meal. We're going to consume a lot of that oil domestically. I'd even suggest the U.S. will become a net importer of vegetable oil in the next year or two, and we'll be exporting more meal. And given sort of what's happening in Argentina with their changes in government down there and their approaches, Argentina economy in the past has been set to do the crush in Argentina, so they're the big export of the products, oil and meal, rather than the whole oil seed. If they take those export taxes off, which has been rumored, they could become a significant exporter of whole seed soybeans and not so much the product. But that's yet to be seen, but that's sort of the talk in the trade here recently.
I would add that the latest projection by the USDA was 161 million metric tons for soybeans in Brazil. Some in country over the last from in-country sources over the last month or so, you've seen projections markedly lower than that at times. And then when a forecast for rain comes on, then they jump back up, et cetera. So I guess the point, Guy, is that we're just in a very uncertain time in terms of what will actually come out of Brazil. And if there's one thing that would come in and shock the commodity markets, it would be that the dry areas that, again, you look at the maps and for much of Brazil, it's dry. It really is. And so they still, I guess, based on their success in the recent years in production, they're expecting, well, it'll all work out in the end, and they'll get a great crop. But the moisture is not there yet to make that happen. So I guess I just would identify that in my own thinking as a potential volatility causing factor in these markets. And where that could go if you raise soybean prices because of problems in Brazil, then you're coming into spring, you're affecting soybean versus corn new crop prices, and it affects planting choices, acreage choices in the U.S. Heading off into March, April, May. So that's something that I'm watching anyway.
Brazil's going to have a record export this year of 101 million metric tons, up about 23 million metric tons from last year's big crop. So and that export program has extended well beyond what it seasonally does, and we just haven't seen that shift back to the U.S. as we usually do in September as our new crop comes off. But that's starting to change.
And our last commodity to talk about real fast, just looking at it domestically, is cotton before we talk about some issues that you're seeing internationally here, Guy. And so, Dan, what are we seeing with cotton?
The most noticeable thing with cotton to me is the decline in prices over the last 3 marketing years. Here in the 21-22 marketing year, we were at 91.4 per 480 pound bale, and then cents per pound, 91 cents per pound for upland cotton. Then last year we were at 84.8 cents. Now we're projected to be 77 cents. So combination of U.S. and domestic factors are leading to lower cotton prices, and I'm sure when you look at 91 cents versus 77, you're tightening margins. And I'm thinking, Guy, that those type of changes affect profitability, and I think we'll be waiting to see what happens in the U.S. with regard to acreage with lower prices as we head off into 2024.
And Guy, earlier you mentioned a little bit of things happening in Argentina, so could you share a little bit more about that?
Yeah, I want to talk a bit about the foreign exchange, which that sort of drives all commodities, particularly export demand. We've seen the U.S. dollar come off about 5 points in the last couple of weeks, last 10 days. That's on the back of the Fed sort of indicating they're not going to raise interest rates in the near future. But just this week, we saw Argentina move their exchange rate from 400 pesos to the U.S. dollar to 800 as the new president Milei took office. He's also making significant structural changes in the government. I think he's only appointed 9 ministers out of 18, so a significant cut in the government overhead. There's discussion, as I mentioned earlier, that they're going to remove the export tax, and we'll see how successful he is in making those changes. But a lot happening there in Argentina nearby as we see that change in government that's going to have a significant impact on trade flows and prices.
And then also wanting to talk about some logistical things, and one of those being involving the Panama Canal.
Yes, a lot of discussion and focus the last few months on the Panama Canal. It's been a bit dry down there, and the big lake, which sort of feeds that water system where they lock it through the isthmus down there, is low. So they've restricted drafts. A month or so ago, they started restricting the number that transit the canal. That's raised prices. And last month, they've put in slots. So now you have to go out and book and buy in a slot, and they're declining. And there's actually a secondary market that's evolved from that. So that's significantly increasing the price of any goods or commodities that have to transit that canal. Now, bringing that back to the U.S. from a grain commodities point of view, it hasn't had a major impact. It sort of changes the flow, but here domestically, commodity either moves off the West Coast, off the PNW, or it moves out of the U.S. Gulf. And we can change that flow very easily by what's been happening. The basis values at the Gulf have got fairly cheap relative to the PNW. So we're seeing, rather than have to transit the canal, we just move our export flows from the western states to the PNW rather than to the center Gulf. So it's having an impact, but not as much as you might see. But it is quite bullish, western basis values versus eastern Corn Belt basis values.
Something else on the water-related front, the Mississippi River.
Yeah, the Mississippi River is running low again this year, not quite as low as last year. But do have draft restrictions, I think, at 10 or 10 and a half feet, which last year we saw barge freight rates well above 1,500% of tariff during gut slot harvest. This year they were running about 600, and then about the middle of October they dropped off pretty quickly. One was just the export demand wasn't showing up. Secondly, and probably the bigger issue is growers, the prices that got low enough, growers just quit selling new crop corn. And we saw that in a 2-day period in the barge freight market, where barge freight just went from 600 to about 300% of tariff. And it's going to be interesting to see the December stocks report. And I'd suggest we're going to see a lot more farmer-owned inventory here in the next stocks report on that. So it's an issue, not as big as issue as it was last year, but it is a concern. Keep in mind about 75% of the water supply going down the lower Miss comes off the Ohio River. So we need some good rains in the eastern corn belt to really recharge that. It's also impacting the cost of fertilizers and other commodities coming back upriver for fall application and spring application of fertilizer, fuel, and those other commodities that move upriver on that logistics.
And what I would wonder, here you talk about the river system, and barge transportation of grain down and inputs back up, all affected. Panama Canal, and in looking at the latest USDA Ag Transportation Report, we don't see a major jump yet, although a little bit of an increase in rail transportation costs, particularly for if we can't go down to the Gulf so well for these ag products. The next place we would go is probably up either through the St. Lawrence Seaway or mainly through the Pacific Northwest. And again, if those rates are jumping, at least with the indicators I'm seeing, I don't see it explosively jumping, but I would wonder about that as happening all that much worse, particularly as the Panama Canal issue prolongs itself. And there doesn't seem to be an end in sight.
Well, one thing, I should have mentioned this when we were talking about the Panama Canal, but we did see the dry bulk freight index double last week, at the end of last week, on the demand for more demand from dry bulk. That was probably coming more from coal and iron ore than grain itself. They all work together to drive those dry bulk vessel values. But last week, it essentially doubled in value in about 3 days. So
wow,
particularly if you're reducing draft, or if you're having to take alternative routes and increasing the distance, you need more capacity to basically fill that demand for that supply chain. It's come off a little bit in the last day, but that jump was rather, I guess, not surprising, but it happened very, very quickly.
Guy, Dan, go for it, sir.
Go ahead.
I'm going to wrap us up. So, Guy, Dan, I appreciate you both taking the time to talk with us today and share with us about the grain markets domestically and internationally.
Thank you,
very
Shelby.
much.
That was K-State grain economist Dan O'Brien and the senior economist at the International Grain Program, Guy Allen. I will link the recent WASDE report in today's show notes on agtoday.net. We're cutting to a short break now, but we'll be back with more ahead.